Welcome to Bar Chart's series of webinars designed to educate you about a variety of market concepts, to inform you of the features and tools Bar Chart provides related to these concepts, and finally to give you some trader's insight to help you make a more informed investment decision. Today's subject, Fibonacci retracements and extensions. So, in the 13th century, an Italian mathematician named Leonardo Pisano Palagallo, later called Fibonacci by his friends, formatted the Fibonacci sequence from teachings that he had learned from Indian scholars. But many centuries before, the Greeks were well aware of this golden ratio that is found throughout the natural world, and they, the Greeks, incorporated it into their architecture and their art. Now, during the 1920s and 30s, as old school market analysis was developing, those traders recognized that stocks tended to correct or pull back in ratios of about a 1/3 or 2/3. Now, it wasn't until the advent of computers in 1970 that market technicians realized that these proportions were actually Fibonacci ratios. And today, when we look at modern algorithmic trading programs, their codes contain many derivative aspects of the original Fibonacci sequence. Now, the mathematics of Fibonacci's are all around us, and they're prevalent in our markets. But here's the good news. You don't need to know what or why, you just need to know how we can use them in our trading. Hello, everyone. My name is John Rowland, and I thought today what we could do is we could look at Fibonacci retracements and extensions, and I wanted to show you how we can use them or apply them in our trading. I want to show you bar charts, tools, and features that revolve around Fibonacci, and finally, some caveats, like all forms of technical analysis are really better served as confirmational and not precise price indicators. But before we do that, please welcome my partner and our moderator, Bar Charts Project Director, Jean Baker. Hello, Jean.
Good afternoon, John. How are you?
I am doing just fine.
Oh, good. And I'm glad to hear that you got Leonardo's name right.
I was so afraid I was going to go into an Italian pizza man accent.
Well,
so let me ask you this, Jane. You tell me you like to go on nature walks, and have you ever realized that flowers, the patterns of flowers or the number of petals in the flowers, did you know that they're related to these Fibonacci sequences?
I actually did not. Nope. When I go out for those walks, I leave the math book behind. So sorry about that.
Well, the next time you go out, look at the petals on a flower and see if they don't correspond with when we look at the Fibonacci relations, 5, 8, 13, and so on, that you'll see that in nature. Okay, you ready to get started?
Absolutely.
All right. So just to remind you all that today's is for educational purposes, and that decisions to buy, sell, hold, or trade securities and commodities or other investments involve risk and invest based on the advice of a qualified financial professional, and that under no circumstances shall we be liable for any loss or damage you or anyone incurs as a result of information or material that you receive through bar chart and or our services. Okay, get that out of the way. All right, Fibonacci's. So what is it and what is it about? So the Fibonacci sequence is really just a list of numbers where the next number in the sequence is the sum of the previous two numbers. And so you can see here 0, 1, 1, 1, 1, 2, 2, 3, 3, 5, as we continue to go higher and higher. Now, what mathematicians have discovered is that as these numbers get larger, as they get bigger, we move closer to some given ratios. and that these ratios are constant throughout the sequence. And the main ratio that we're going to talk about is, or that how Fibonacci has been developed, is this golden ratio, this 1.618. So for instance, if I look at 34 as a relationship to 55, and I divided 34 into 55, then I would get a result of about 1.618. And there's ratios as we go up and down from our numbers. In other words, if I go down one number or two numbers, then the ratio will change, but that ratio is consistent no matter what number I pick and no matter what other numbers I move away from it. So what we're going to do is we're going to look at these ratios in our Fibonacci's. And these constant ratio relationships between the numbers in the sequence is the bedrock of the ratios that are used by modern day technical analysis to help determine potential support and resistance levels. So I'm going to just kind of make it easy for you all on today's session. And so when we look at retracements, and I'm going to talk about this in a little bit, I just want you to kind of, if you're new to this, I just want you to kind of look at the 38, 50%, and 61% retracements. Now, a percentage is just a ratio times 100. On the extensions, we'll look at the 68%, 100%, and 168. Are there other ratios? Yes. Are there other ratios? Are they relevant? Yes, they're relevant. But I just kind of want to make this simple for you guys and watch these few. All right, so why Fibonacci? Well, sometimes it's called the divine ratio because it's in nature. And it's very aesthetic to us. It's very pleasing to the human eye, this aesthetic of this divine ratio. But in terms of technical analysis, also, it's very easy to recognize patterns that have this ratio. And in a world of price randomness, this is kind of how technical analysis is pattern recognition. But more importantly is that there's this acceptance or adaptation of proportional analysis, segmenting price movements into directional impulses and corrections. And this is really the basis of Elliott wave theory. Now, we're not going to go down the Elliott wave theory rabbit hole today. I just want to kind of make it simple for you. So as large number of traders are using this data set, these Fibonacci's, and their reactions or their conclusions, right? More importantly, probably their reactions will be similar. And therefore, these Fibonacci levels become a self-fulfilling prophecy. So for us, it's not that we have to believe in them. It's just we need to know the fact that thousands of other traders do believe in them. And then this golden ratio. So finally, the math of Fibonacci sequencing and these ratios are found in today's modern trading programs. So I don't know if you knew, but it's widely accepted that algorithmic trading accounts for about 90% or more of trading in all markets, stocks, Forex, futures. Again, leading to this self-fulfilling prophecy. Okay. Excuse me. So let me boil this down for you. You don't need to understand Fibonacci's. You don't even need to know how it's calculated. All you need to understand or know is that their acceptance is influencing markets. And hopefully I'm going to show you how we can use them to predict, confirm, identify support and resistance, help us in choosing targets, and define our risk movements, our price movements in terms of implied risk. So what I'm going to ask you to do today with me is to take a leap of faith. Don't have to believe in it. I just want you to watch what I'm going to show you and see if I might convince you that you might want to start incorporating Fibonacci's into your trading program. All right, so what I've done here is I've opened up the S&P index, and this is a 20-year chart, but I'm really looking at monthly candles here. So let's first start with the Fibonacci Retracement Tool. First of all, where can I find it and how do I use it? So over here on the left-hand side, you can see these columns here where we have these little symbols. So the second one, if we open that up, there are our Fibonacci tools. Now we have several Fibonacci tools. We have channels, retracements, extensions, arcs, fans, and we actually have something called a Fib time zone. Now for time sake for today, I'm only going to do the retracements and extensions. If you're interested in the other ones, just Google them and see how you can process them. So I can find them over here, but I can also find them up here in the tools. And if I'm just on a chart, I just right click on the chart and it says add drawing tools. Now, when we draw our lines, sometimes it can be a little difficult to draw lines or, to get our Fibonacci's in the right positioning. So one kind of little tip for you is, click on this snap to the closest price, and that'll help with you when you start to draw your lines. All right, so let's start with the retracement tool. We can retrace any price movement throughout any time frame. So all we really need to do here is to identify a trend. And then what we're going to do is we're going to connect a swing low with a swing high. Now, what is a swing low and what is a swing high? Well, that's basically just in a price movement where price stops going down, swing low, and starts going up. And a swing high is where price stops going up and starts going down. So here we have this chart that goes back. Here's back in March of 2009, the start of quantitative easing, right after the financial crisis of 2008. I'm going to click on Fibonacci retracement, and I'm going to just draw a trend line all the way to the high that was just created just recently. And again, this is just a large trend. That's all this is showing us. And then what I can do is, at this point here, is I can start looking at those retracement lines. And then in this case, it says that a 23.6% retracement would give me this value. A 38.2 retracement would give me that particular value. Now, it doesn't matter how big a trend I use or the price movement I create, as long as I'm using a consistent high or a consistent low, swing high or swing low. Notice that if I did a Fibonacci retracement on a different price movement, let's say again from our financial crisis low, and let's use this high here, where right before the COVID, notice again, now you see a price movement where price came back and retraced to that 38%. And then price went higher. And I could just do it off of this one here. And then this one, this little high here, notice we had a retracement of that 23%. So let's talk about that in terms of bull and bears and uptrends and downtrends. Now, from my experience, what you will notice is that bull markets tend to have shallower retracements. So if I click on my line here, it's a little hard to see there, but if I click on my right click on my Fibonacci line, there's are those ratios that we're talking about. And the ones on retracements, we're going to look at the ratios between the 0 and the 100. And so we have 23, 38, 50, and 61. Now, 50 is not really a Fibonacci number, except that, 1 to 2 is 50%. But it is one of those accepted ratios that traders use. Again, this acceptance of self-fulfilling prophecy. So in bull markets, what we normally see, we see shallower retracements. So what I wanted you guys to kind of concentrate on is that 38 and 50s on bull markets. And then in bear markets or downtrends, we tend to see deeper retracements. So we will look at the 50% retracement and the 68% retracement. Right. So the other thing that we can start doing with Fibonacci's, and regardless of the time frame that I'm looking at, is I want to start looking at where the Fibonacci lines fall in connection with my price action. Now, this is kind of the lure or the mystique that is around Fibonacci. For instance, let me get rid of this one here so you get a little bit clearer. Notice that I remember we drew this first one. This is based on what the market has done over the last 12 years. But notice this price action here. This is during the COVID crash of the COVID, right? That happened 2 years ago. And yet here's a high that we just did a retracement on that gave us this range between the 38% and the 61%. And notice that this price action is relatively similar to this ratio. How does a price action that happened 2 years ago relate to a high that hasn't been made and now is relevant today? This is kind of the mystery and the mystique of Fibonacci's. All right, let me check my notes here. Okay, so let's do this. Let's change our time frame. I'm going to go to a weekly chart now. And again, I'm going to just draw my retracements. I'm going to go from the COVID low back in March. And again, I'm just going to use that high. And again, what did I say to you? That in strong bull markets, we tend to have retracements that are a little bit more shallow. And for instance, on this one, let me just change the color so you can see the difference here. So the purple represents the COVID retracement. And what did we get? We got a shallow retracement at that 23. Now, does that mean that the market is going to go higher? Maybe, I don't know. But it's telling me now that, maybe this is a strong bull market and this is just a short-term correction. If price now goes below here, then we would start thinking about the next level of correction, which would be around that 38%. But then what we can start thinking about is as I move Fibonacci's through multiple time frames, what I want to start looking for is where they start to converge or where we start seeing clusters of the same Fibonacci levels. Notice that I did 2 retracements, one over a 12-year period and one over a 2-year period. And the 23 of the 20-year period that from 2009 is that's that first retracement. But it also is the 38 of the COVID low. And the 38% retracement of that bigger monthly time frame is the 61% of the COVID. So when we start seeing these clusters, that makes those lines even more significant. In other words, when price returns to them, they become more relevant. The other thing that we're going to start looking at is where do these lines fall in terms of our price action, in terms to what our chart is doing or what our trend is doing. So that's what I drew these lines in preparation. And you can see over here to the left, well, what went on here? Well, I mean, this little doji candle here, right? It's kind of an engulfing doji candle where price was moving up, and then we had a pause, and then price moved again, right? So that can become significant. If we look at this cluster of Fibonacci's and we look at our chart, well, what do we see? Well, here was our V bottom. We found a little bit of resistance. Price gathered energy, then it broke away, came back, tested. This old resistance becomes new support. Technical analysis, tested it a second time, and then price moved away. Now that value happens to become a Fibonacci level. Again, this mystique of Fibonacci's. So those two concepts are things that we're going to start watching for in terms of clusters and how does it relate to our stocks, excuse me, our trends. All right. So let's go down to a lower time frame. Now I'm on a 6-month chart and a 6-month daily candles. Now I'm looking at daily candles. Now I'm going to just leave those correction retracement lines up. But now let's look at what's going on in the market currently. So what do we see? Well, we see what is our trend? Well, our trend is definitely down, right? A series of lower lows and lower highs. That's how we define a downtrend. So we can still use Fibonacci retracements in that process. So let's look at, first of all, let's look at this first little wave where price fell, held, and then retraced. And what did I say? In bear markets, we tend to see deeper retracements. And notice on this retracement, we got up to that 61.8%. Let's look at this retracement, this wave, this leg down. Here is a big price movement to the downside. Here is what some folks are now saying is a tradable low, where we get a retracement back to that 68%. Okay, and so let me get rid of this so we can see this a little bit clearer. Whoops. There we go. And let's look at our last leg. And you can see that today we captured that 61% level, and now we're just a little bit back below it. So is this a correction of this leg? Looks like it, right? All right. So let's do this now. So we had shown you how we can use the retracement tool, but let's now go to extensions.
Yeah,
all right,
John, so I'm gonna stop for just a second because it's come up a few times, and actually you just demoed it. You know, a few people have been asking, do you always have to go from a low to a high? You just demonstrated how you can also draw these from a high to a low, correct?
Yes, yes. Yeah. So if I'm in an uptrend and I've identified an uptrend, if I'm going to do the retracement, I want to go from low to high, up, right? If I'm going to go on a downtrend, then I want to go from high to low to draw my retracement. So good question there, Jean.
Yeah,
thanks.
Perfect. Okay, thank you.
Okay, cool. So here is our extensions, and let's do an extension. Now, extension drawing the Fibonacci tool is a little bit different because the retracement we just need to connect a swing high or swing low. For an extension, we need 3 points. So first what we're going to do is we're going to identify that trend, and we're going to connect that extension by the correction. So for instance, in this one, I'm going to come down here, and that was that first low. I'm still holding left click. Then I'm going to release my drawing tool and then let it rally back up, pick that correction high, and then left click again, and that's going to set it. And then we can see those extensions: 61, 100%, 127, 168. Again, these are more target levels for us, where we're looking for an extension of the previous price movement. So in other words, this length from here to here, if I did that in a value, this length here, 100%, would be equal to this previous leg or the previous wave. And that's what an extension basically shows us. Let's look at this extension. So again, I'm going to left click hold. I'm going to connect my high and my low. I'm going to let go. Then I'm going to find the high, or in this case, the high of the correction. And then I'm going to set that for my value. And then what I can do is look at my chart and look to see where those Fibonacci numbers align. Now, notice that our 120 extension, 127 extension, is right around that correction value from the higher time frame. Let's go back and look at that first one we drew. Let's say from here to this high. And what do we see? This price movements extension at 127 falls very close to the same price of the 127 extension of the last leg that we just had. And it's also right near that correction value. So this, again, this is this cluster that we're going to start thinking about. If this market is in a downtrend and I'm looking for a target, or I'm looking for an area where I believe the market might turn, I'm going to be more patient and look for this value, because we have two extensions and a correction from multiple time frames that are coming to confluence in a very narrow area. Okay, so the other thing that we can start looking at is if I'm picking out values. Let me go back to a 1 year chart. Let's see if I can show this a little bit better. Yeah, it's going to work a little bit better. All right. So for instance, let's say in the case of the S&P, I'm thinking, okay, this is an area where I want to start buying the market. I'm going to start thinking about buying the market or looking for a buying opportunity. So, there might be some risk in here, a lot of risk in here. So one of the things we can do is, and I'm going to move forward on this one, is I'm going to show you some techniques as we move forward today, how we can kind of refine this area as an objective area for entry. All right, so let's do this. Let's move away from the S&P and let's pick a market that most folks are very interested in. This is Apple. And I'm going to start at the weekly level. And just for, keep us moving along here, what I've done is I did a retracement based on the COVID low and our most recent high. Now, it looks like my number is just off a little bit. So let's make sure we're in the right number. There we go. And again, we talked about, is this a strong uptrend? Yeah, it has been a strong uptrend, and that price tends to come to the shallower Fibonacci's, and you can see that recently we just came down and tested this 23 percentile, and now we're back up. We actually tested it twice here, looks like, and we're back above it. So then we could start thinking about maybe a new uptrend. But if price falls back below it, then we'd start thinking about this 38% retracement or even lower level. So as we violate one level, we start thinking about the next level. Again, what was some of the things that I said do you look for? We're just not going to take these numbers as a hard number. We want to make sure that we have some kind of technical analysis that will back up these numbers. Now, for instance, this number here, if I brought this little line up here, what is going on at this level? Well, right, we had a nice rounded bottom where price gathered energy and then it broke out. Not only did it break out of these little highs or resistance here, but also this green candle broke out of our all-time high at that time for Apple. So do you think that this is a significant level for us to retest? I do, and the market has retested and is now responding to it. Now let's look at our 38% level. Again, right? Resistance broke out on a big candle. And again, if we did some other technical analysis, maybe we looked at volume, we'd probably see some big volume on that day. And look at our 50% retracement, right? Again, this breakout moved away, came back, old resistance becomes new support, and again, this price action. All right, so let's go down to, again, a smaller time frame. And let's look at this last leg right here. Let's start around November. All right, so first let's do a retracement, see what happens. There is our low, there is our high, and you can see the first test, the first retracement was that shallow 38%, and then price went up and made a new all-time high. Let's do a retracement correction off of our price action to the downside. So again, that first leg down, there it is right there. Where was our correction? 61.8%. Now, would I have looked for take a short in this? Well, the Fibonacci is telling me this is a correction level. Well, where does this line up in our chart? Well, it lines up right here where we made a newer low from the last time when we made an all-time high. So does that have technical significance? Yes, it does. But let's move now and look at our last leg. Where we had that, what some folks believe is a tradable bottom. And again, we retrace deeper in this downtrend. Again, that 61% number. So the other thing what we can start doing is we can start using other technical analysis in terms to confirm these Fibonacci levels. For instance, on this one here, we looked at this first leg. What is this candlestick doing here? Well, in candlestick theory, this would be called an evening star. And notice that we had an evening star and then a big engulfing candle that engulfed both the evening star and this green candle. That would definitely be a reversal signal. On this one here, this one is a little bit harder to identify. It's close to what is called a piercing line candle. It might be another type of candle. I'd have to look it up. But again, think about the price action. We gapped up higher, right? Gapped up higher, and then we closed lower on the day, and then the next day we gapped lower. So that is definitely a reversal indication. All right. So let's now do some extensions. So let's extend this price movement, this retracement, and let's extend this price movement and this retracement. Okay, so what do we see? Well, do we see any confluence in here? Not yet, but we do see down here our extensions of 161.8 are very close to our 38 percentile. So again, this might be an area targeting, if I was in a downtrend, I'd be a little bit more patient and waiting for that trend. But when price got down there, I'd probably be a lot more quicker to take some profits. If I'm looking for a buying opportunity, again, I think you might want to be a little bit more patient at this time, because even though we have had a rally a little bit in the last day or so, we're still in a defined downtrend, and we might need to go back down to that higher time frame correction level of that 38%. All right, so how we use candlesticks to kind of confirm our Fibonacci values, and also, again, thinking about those clusters in terms, in this case, of our two legs down. Our clusters, again, are in the same kind of that same area. All right. Now, again, let's look at this in terms of our structure. So let me just go out a little bit in our time frame. And again, where our 28 was, is there some kind of structure here that would tell me that this probably would be a good level for price to retrace from? And yeah, right. So we had a little bit of a rally up. We created resistance. Price gathered energy, and then it broke out down here, where we said we might start thinking about targeting again, right? Again, another area where trend was starting to gather momentum, paused, broke resistance, and then shot away. So again, trying to reinforce these zones with structure and price action, previous price action. All right. So now what we can do is, let's say, for instance, this is an area that I want to start thinking about putting risk on, or I'm going to want to buy this particular stock. So let me move to another market, and so we can kind of break this down and show you kind of another cool little technique we can use. So let me go to the GLD, and this is a market that has definitely been in the news, gold, inflation, all that. And so let me start at the weekly. And just for reference here, I just kind of want to, again, reiterate some of the things that we were just talking about. So I already drawn a line based on this low here and this high, and I did my retracements. Now, this is what I would kind of, this mystique that falls around Fibonacci numbers is, here's a high and a low that was created, and then from that point forward, notice how our Fibonacci numbers, right, price kind of is range bound in there, and that when we break below one level, we move to the next level, and then when we range bound from one level, we broke out and moved to the other level. So again, this is kind of this mystique that is around Fibonacci. But let's go now to a lower time. Well, let's do this. Let's go from here. Let's do a retracement from this time frame. And let's go from this low here, this 61% retracement from the previous leg, to this high over here. And again, notice what we're seeing, that we're seeing this cluster of our Fibonacci numbers. And that could be an opportunity for me to look for a trading entry. So let me drop down now to, let's say, daily candles. And again, let's draw another correction or retracement. And let's just use this leg. And let me change this color so that we can see it. So now we have a cluster of Fibonacci's right around here. And we have another cluster just off of this low. So what can we do here? Well, now what we can say is, all right, I want to buy gold, the GLD, on this correction. And I'm waiting patiently for price to fall down into this zone, this area where my cluster of Fibonacci's are. But if I looked at this trade and I did an extension, right? In other words, this impulse wave up and this correction down, if I bought down here, where would be my potential target? So let me do this. Just going to eliminate these lines. So it's a little bit clearer for us. I'm going to leave the green ones up just for reference points. But there was that cluster. This is what was represented by the blue line and this little blue line here. So I'm now thinking that I want to buy somewhere in this area, in between those two Fibonacci numbers. So let's do this. I'm going to go for an extension. I'm going to go and take out this last leg. And what is my correction right there? And so one of the techniques on the extensions that we're going to do is we're going to be a little bit more conservative about picking a target. And that target we're going to pick is going to be, that first target is going to be that 61.8. Now, if we have a strong bull market or a strong bear market, then you normally will get that 100%. And if you have a very strong market, then you're going to get those sequence that are higher. But for determining risk for this particular trade, I'm going to be very conservative. I'm just going to look for that 61%. I want just to get 2/3 of the last price action. So let's look at this trade. If I'm going to buy here, somewhere around $1.80, $1.81, and I'm looking at my structure in terms of where will I determine that I'm wrong, well, if it fell below one of my Fibonacci's, then it's going to fall to the next level. So that would be off of this low candle here. So that risk is about $5. My target is around $94. So I'm risking $5 to make about a little bit less than $13. Now, is that a good risk reward ratio? Not particularly, right? It's a little bit less than 3-to-1. For trading, we really kind of want to start focusing on those 3-to-1s or graders. But here's where we can use Fibonacci, not in terms of price action from previous price action corrections and extensions, but we can use the tool now to help us define the zone, the area where we're going to determine where we're going to be a buyer. So let me do this. So again, so that you guys can see this very clearly, I'm going to delete that extension. Just remember that our first target is right here. I'm going to come into my Fibonacci, and I'm going to get the retracement tool. Now, again, if I'm looking at a demand zone or a support level, then I want to go from bottom to top. If I'm looking at a resistance level or a supply zone, I'm going to go from top to bottom. So bottom to top, and let's get this. Sometimes, there we go. Get a little cursor there. Oh, there we go. Now it's moving. There we go. And let's make this nice and big for you. So what I've done now is I've divided this zone into Fibonacci segments. And what I'm going to do now is I'm going to wait for a deeper penetration into that zone before I commit to risk. Or what I can do is I wait for price to return into my zone, and then as it exits the zones, I will determine if that is a good price action. So for instance, on this one, let's kind of tighten this up a little bit. Notice that price has now come back into our zone, but where did it fall in that zone? Well, it fell in that deeper penetration, that 50% penetration. So let's look at this in terms of risk reward. So over here down in this tool section, we have a tool, it's called risk reward. So let's think about this. I'm going to buy halfway into this zone, and that level looks like it's around 178.05. So my entry is 178.05. Where am I going to stop myself out? Below that last Fibonacci level, and which also corresponds with this low, this new low what we'd be creating. And that value, it looks like it's around 175.26. 175.26. What's our target? Well, we already picked our target based on that 68%. That looks like it's around 194.46. 194.46. And what is our risk reward ratio? 5.88. Much better risk reward ratio. Now let's go back to the original trade. Let's say I wanted to buy right on that Fibonacci retracement level at around 38%, which was right here. That would have been that entry. Instead of having an entry that was a little bit deeper, a little bit more patient, we would have had an entry around 180.80. I think was the number I looked at earlier. So let's change that. Our entry is 180.80.
Whoops, 118.80.
Yeah, got it. 118.80. Well, notice again that risk reward ratio is 2.47, a lot less. So what this technique allows us to do is to find an area where we feel comfortable getting long the market, but making just a small minor adjustment into where we're going to enter the market can increase our risk reward significantly. Same zone, different risk reward ratio. So this is kind of a real cool little technique that you can use the Fibonacci tool to help to define potential supply and demand zones or support and resistance, or how to define or reduce your risk in terms of risk reward ratios. Okay. So let me see how we're doing on time. Ooh, getting close to the end. So I want to answer a couple questions here, but I do want to show you one more technique. So let's do this first. I'm going to answer a couple questions. So Gene, I'm going to look at these. Is there any questions that are kind of coming up there?
Well, a few things I do want to point out, and I know that John has demonstrated this. To access the tool's properties after you place the tool in the chart, you right-click on the tool, it'll pop open the parameters box, and that's where you can change the color of the lines for the Fibonacci's, the line thickness, the different levels to display. So right-click on the tool and then open it up like John just showed you here.
So, Gene, when I'm reading more questions here, is also talk to him about how just being a member, not necessarily a premier member, that if we draw these lines, these Fibonacci lines, how they will remain on our charts.
Right. So as long as you register for even a free bar chart account, we automatically save any annotations that you place on your charts in your account, and they will be there the next time that you come back to them. Now, if you just visit barchart.com as a site visitor and you never bother to create a free account, we don't know who to save these trend lines and on what charts. So register for a free account, or if better yet, use Barchart Premier, and you'll be able to get access to the full set of Premier features that you have available for you. One other thing I do want to point out, a lot of people are asking, is this session being recorded? Yes, it is. And toward the end of the session, John's going to get to our webinar archive area. You're going to get an email a little bit later on this afternoon once the recording is available. We also place all of our webinar recordings on our YouTube channel, so you can find it there a little bit later on this afternoon.
Okay, great. Thanks, Gene. Appreciate that. All right, so let me just answer a lot of questions I think I've already answered here about the difference between extensions and retracements in terms of, identifying that trend. But here's a great question. Is there any better to use the closing prices rather than the absolute high and lows when drawing? And this is from Robert. So Robert, no, there is no difference, really. I mean, it's just your style of a trader. And when you're looking at a higher time frame, let's say monthlies, weeklies, even dailies, and if you're using closes versus the absolute high and absolute low, when you draw your lines, you just do this as a test. You'll discover that your Fibonacci lines are in statistics is probably not very relatively that much different. But I will say this though. Just be consistent. So whatever you do, make sure you use that technique consistently through your process. In other words, if you're using the high and the low, then stay with the high and low. Don't use the close for the swing low and then the ultimate high as your swing high. Just be consistent throughout. My personal preference is I like the highs and the lows. But again, sometimes I will do the closes just to kind of see where they'll fall in line. So there's a question here from Dan that says on extensions, those percentages mean the percentage of what? And there's another question, I think it was from Matthew, asked same kind of thing. So that is not a probability percentage. In other words, like for instance, like in options, that is just the length of price movements in what we call this proportional sequencing. So I measured a wavelength, and now I want to know what the proportions of that wavelength are. What is its 38%? What is its 61%? And then if I measure that wave, and then we have that correction, and I want to know another wave that's going to be similar to it, then that proportion would be, those 68s, 100%, 168. How far could price move to create an identical wave or leg from the previous leg? So that's what those mean. That's not a probability. It's just a proportion of the price movement. Okay. So let's see here. Let me read a couple more of these. A lot of great questions, by the way. So David asks, like you're talking about as a potential trading opportunity. I think maybe because I did it in the S&P and the Apple, but then I showed you how in the gold. So David, if I didn't answer that question, send it to support and see if we can answer that question for you. All right, so Matt said I meant might. Again, Matt was asking about the probability. So Raphael is asking, isn't it just easier to follow preview support and resistance? So again, this is just a tool, Raphael. If I've already created a support and resistance level, that be it multiple other technical analysis, then then I draw my Fibonacci's and they fall right on that level or in that level, then that just is more of a confirmation that I've drawn a good levels. And what I've done is just done it from the Fibonacci aspect first, and then what I do is I confirmed it with the price action or the support and resistance level. So I think that you're asking the same question. You're just coming at it from a different angle. So Ricky asks a really cool question. He says, you're using relative high time frames. Does this apply to lower time frames? Yeah, again, I said you can use Fibonacci's through multiple time frames. Matter of fact, when you start using Fibonacci's in what I would call micro time frames or intraday time frames, hourlies, minutes, whatever, what you'll discover is that a lot of times your numbers are actually very, very precise. In other words, price will literally touch the number to the penny, and then price will react to it and move away. But the other thing that you'll discover is that the price violations will be a lot greater. In other words, you'll get that first touch to that 61% retracement, and then price will move away from it. Now, it might not move away a lot from it, and then it comes back and it'll come back to that number again, and then price will blow right through it. So if you're going to use Fibonacci's in micro time frames or intraday as a day trader, yes, they work. They are definitely tools. Again, I would use them more in a supportive role, but only rely on first touches. Okay, so just be careful with that one. All right. Wow, a lot of questions. I don't know if I'm going to get all to these questions. Chart is consolidating. There's no
Right.
clear uptrend.
So
Go ahead, Gene.
if you've passed through a question for John and you don't get an answer directly, please email our support group, support@barchart.com. We've got a great group of people there that will be happy to answer your question, and if necessary, they can confer with John to get a good answer for you.
All right, so let me just do two more and then we'll move on. So Jason asks, does a break of 61.8 generally signal a contra trend movement or a failure from the previous trend? So yeah, I think that you can kind of use that as a guideline, especially in uptrends. If you get in that deep retracement in an uptrend, that usually is a sign. Now, if you go back and look at do some Fibonacci retracements on the S&P and also on Apple, on that last leg when we started to make newer highs, but the newer highs were getting smaller and smaller in terms of price movement, what you'll notice is that the first punch through was a 38% retracement, and then the second punch through the retracement was a 61% retracement. So what is that telling you? It's kind of telling you your momentum is changing. So yeah, Jason, that's a great question. If I'm seeing a strong uptrend and it's doing shallow retracements, and then I see a deep retracement of 61, but then that trend continues, that might actually be a sign that your trend is starting to lose some momentum. So that could be a signal. Now, if it falls below that, then that would be probably more of a contra trend indication. Okay. All right. So where are we at? Okay. So I am getting a little at the top of the hour. So I did want to show you one more thing. So stay with me. I know that I like to finish up in around an hour, but I think one more example. And this one's already set up, so it'll go pretty quick. So here's Alcoa, and so what I did was, here's our trend. Here's identified my trend, and then what I did was, excuse me, it starts over here. I did an extension, and so a lot of times I get from students is they say, well, I pick a good zone, but I don't know when to get out, all right, or market's going in my favor. When do I know to get out? So here we had a trend, we had a correction, and then we did the extension. So we're assuming that we're still into this position. We're still long this position, or maybe we bought this position as we got the breakout from this high. So what I say to you, so the first target we want to look for is that 61.8. That is a very easy target for any trend to achieve. And then our 100 would be a second target. Now, in this case, what we could do is as price captures those Fibonacci's on the upside in terms of extensions, and the same works for the downside trends, is what I can do is start moving my trend. Sometimes you might have heard something called like a technical trailing stop. Well, this would be a great example of that. As price breaks above this Fibonacci level, then I'm going to raise my stop. As it captures the next level, I'm going to raise my stop. As it captures the next level, I'm going to raise my stop. The other thing we can start doing is using other technical indicators to help me discern if maybe I'm going to see a price reversal action. Again, candlesticks is a great way to do that. But in this case, notice that here we're getting price appreciation, and our MACD, this is what is down here. These represent, this is our MACD and this is our RSI, two technical indicators of momentum. Our MACD is still showing a positive divergence. In other words, it's still going up. Even though we got a little bit of a correction here, still traveling up. That would give me more onus to saying that this trend is still in control. Now, even though the RSI was a little bit overbought. But notice that when we captured this 161.8 up here, our RSI was in the overbought scenario, but it was making a lower high. This is called a negative divergence. And that would have been a signal for us that maybe momentum is starting to change. And you can see during the same time, our MACD is starting to turn. Now, it did cross right there. That would have been, again, that's another signal. But if I went to a lower time frame, and here is where we captured that 161.8, well, then I'm going to start moving my stop up. Maybe I'll move my stop off of this. This would be the 138. But now we've captured that. Now I'm going to move my stop just below that. And once price breaks that line, ring the register. I'm gone. Right? I'm out. Notice again in the lower time frame, and this was, I think, Raphael's question. Notice in our lower time frame here are both our RSI and our MACD are signaling to us that momentum has changed. So again, using Fibonacci's here now to be a little bit more patient, capture more profit, but also once price takes back, this could also be an indication for me to exit a trade. Okay. All right. I apologize for going a little bit over. So let's go back to our slides. Oops. Some days. All right. So couple takeaways. First of all, Fibonacci lines are subjective and should only be used as considered levels, not absolutes. And we still need to use other confirmations. So candlesticks, moving averages, trend lines, RSIs, MACDs, Bollinger Bands. I didn't get to show you on that gold trade. What we had seen was that price had fallen just to the 20-day moving average, and the lower end of that zone was the 50-day moving average, sort of what I kind of like to call the strike zone. I want to buy, I like buying in between the 20-day moving average and the 50-day moving average. And so that zone had a lot of moving average merit to it. Fibonacci's can be applied to all time frame, Raphael, right? But they have greater accuracy and probability at the higher time frames. So monthlies, weeklies, dailies, right? So even for my day traders, draw your Fibonacci retracements and extensions at the daily level, and then use your lower time frames to use your other technical analysis to confirm momentum, potential change in price. Higher time frame probability, big picture, big money. And then finally, we're going to focus on these clusters or concentrations where our Fibonacci lines are coming together, this kind of confluence, right? And again, we always want to look in concert with our trend, right? So in a higher time frame, I'm seeing a retracement of 38% is also the corrective wave, right, of the 168 extension. That was the example I showed you in the Apple. In other words, the old all-time high is where price broke out, and all of these things come together, and that would be a great area for my entry. An old high becomes new support. Okay. So I just want to remind you all that, one of the cool things about bar chart is we do allow you to try out our premium features. But again, what Gene was saying, just being just a regular subscriber, when you start drawing a lot of these lines on your charts, and this is what I do as well, I'll just draw these higher time frame lines on my chart and I'll just leave them on there. I forget about them, and all of a sudden the market comes back to them like a week, 2 weeks later. I'm like, oh wow, this is a line that I've already discovered. And so then I start thinking about enacting some kind of a trading practice. All right. So I know what Gene's going to ask me to do, and I know we're a little over.
All right, so let's talk about next week's session.
Yeah, whoops. So next week, I forget what next week's session is.
So
not archive.
Right, not archives. That's where today's session is going to be a little bit later on this afternoon, but upcoming webinars.
Remind me. Oh, yes, protecting profits with options.
Oh, yeah.
Okay, so this session, what we're going to do is we're going to look at options as a way to protect our portfolios. In other words, let's say I have a stock that has been performing really well, and I want to make sure I can lock in some profits, but I still want to stay in the trade. And so options will allow us to do that. And so I'm going to show you some techniques where we're going to use covered calls. In other words, we're going to sell a strike above current price, collect a premium, and use that premium to buy protection to the downside. So there are some nuances you need to understand. Is that if I sell a covered call, that I'm actually, there is the potential that somebody could call that stock away from me. But if I do a good job, I should be able to sell covered calls high enough where price will not get to me and create enough income to help protect me to the downside. So join us for that section. I think you're going to enjoy that one.
Right. And just so you know, okay, John, if you can scroll down a little bit on the page, a few people are asking, where do I register for it? And that link is right there, reserve your spot. It'll open up a registration window where you can register. I also want to point out, very top of the page right there, we do post all of our webinars on our Bar Chart YouTube channel. And if you subscribe to the channel, and there's a little bell, I guess you ding on YouTube. And once you do that, you will get notifications whenever we do post any new content to YouTube. So you can do that as well. But keep yourself in the know.
Well, Gene, thanks for helping make my session a success today. I hope everybody enjoyed today's session and get out there and try these Fibonacci tools. Again, remember, we're going to use them to enhance our trading. They're not a given, but again, there's this kind of self-fulfilling prophecy, this mystique that it surrounds them. And so until next time, I want to wish you all you stay safe out there, the best of health, and the good of all trading.